All right. Good evening, everybody. Good evening, everybody. And so I always like to kind of get the party going, try to get the blood going. So a little bit of Van Halen. Hope you don't mind. But after a long day, helps to hear a little fiery music to kind of get the blood going. So tonight, sorry I'm starting a little bit late tonight, but most of you guys here are members in the room. And as you know, I broke my ankle this weekend, so kind of moving around in my place. And recording is on. Thank you for the thank you for the reminder. I normally don't forget to turn the recording on until about halfway through the webinar. So we are recording. So thank you very much. Appreciate the reminder. And yeah, so anyway, so I'm every day I've been about 5 to 10 minutes late with doing stuff. Just trying to get used to hobbling around and so forth. It's not as easy as luckily I'll only have to be off my feet for about a month, I believe. So I'm going to suck it up for a month, and certainly makes you appreciate walking and being able to get around easily. Yeah, I could put you into host. Absolutely. Sorry about that, Pat. Okay, so what we're going to cover tonight is a little bit of earnings strategy. We're halfway through earnings. We just had these weeks for me, they get very hectic. There's so many names reporting every day, and I don't want to miss anything. So I'm kind of all over the place. Want to make sure that, there's a lot of opportunities out there, and you just don't get to, we're going over so many trades during the day in the trading room. You just don't get to go over things at a leisurely pace and, try to answer as many questions as possible. But at the same time, you want to keep moving on and keep checking out trades. And I wanted to kind of go through the methodical approach that I take to earnings trades. And thanks. Yeah, I'm getting over it. Thank you, Catherine. But so I wanted to go over earnings trades at a leisurely pace. And this is a trade that I think is not an easy trade at all. It is very, very difficult. And so I wanted to go over strategies to kind of, my return on investment for earnings trades the first 2 weeks is 50%. That doesn't include this week, but you can go down in the notes. You can see everything if you're not used to this room, or you're not a member of Tribeca Trade Group. Feel free to kind of look around. It's full transparency. We let everybody talk to each other. I don't hide anything. We let everybody have conversations with themselves. It's more of a community room. All the trades that we do are listed. I do have a section called earnings trades, as well as, where are these things? Earnings and event trades. It's about halfway through. If you notice, the notes tab is all the way we call it, they're pods in Adobe, but in the bottom left window, you can see these are all the active trades that we have on. So what we're going to be talking about is earning trades. If you go down to if you scroll down, you have to scroll down in that section, and you'll see in pink fuchsia this week's earnings trades. I think I've had 1 or 2 that haven't gone the right way, but other than that, a lot of them are going the right way. So I'm going to get into that. So I think that will actually bring the point of that is, I think that will actually bring my return on investment higher. I should be around 60%, somewhere in that ballpark for now that we're just about 3 weeks into earnings season. And then I also wanted to go over, we just had an FOMC meeting. Always a good time to kind of regroup and re-strategize. Get the results from that meeting, and then come up with a plan afterwards. So, quick risk disclaimer, please go ahead and read this. So this is all being recorded. So if you have to leave early during the webinar, no problem whatsoever. I'll send it out. Okay, I see most of you in here. You guys all know me, but in case anybody new that's in the room, I'm the CEO founder of Tribeca Trade Group. We started this back in March, so we're very, very young, and having a great time. I think, after 3-4 months, I think the room has been going great. It's exactly how I envisioned it. Like I said, full transparency. Everybody's helping each other. We all want to make money, and we're all helping each other do it. This week, I'll be honest, I've had a bad week. I've taken a couple bad trades, and kind of went over those trades in the room. and why, what went wrong with them. So you always want to learn. As a trader, you always want to learn what went wrong so that you don't make those same mistakes again, and you minimize them. Other than that, I've had a real good June. And July, we'll see how July goes. I should finish up for July, so that should be good. But the month's not over yet, so we'll get to that. So my style of trading, very much a macroeconomic style portfolio manager. I look at all different types of trends, try to spot things that are really moving. Is it, oil, copper? Is it currencies? Is it international areas? Is there, there's a Bank of Japan meeting tonight. Want to always be aware of these things, and then I want to drill down. So it's kind of a top-down approach. I want to look for sectors, the sectors that are moving, money that's going into sectors, that helps me spot trends. Then I don't necessarily have to buy the whole sector. Then I can look for leaders in the group and look for unusual option activity in the group. So that's pretty much I'll get into more, more trends and so forth, but that's my style of operation. I trade everything: equities, ETFs, futures, FX, commodities. I don't trade futures like I used to do. I used to have Series 3, so I used to trade futures all day long. So I'll get into futures trading, and I'll touch upon futures trading a little bit and what kind of market we're in right now. What's my background? I actually started off at Morgan Stanley a long time ago as a financial advisor. And that was back in the 2000 days, the bubble days. And then I took a little bit of time off, went back to graduate school, realized I didn't want to be a financial advisor. I wanted to get into trading. And from there, I went to Merrill Lynch and worked my way up. And we were actually talking a little bit about customized indices today. But I was a senior Delta One trader. And then I was a senior ETF trader as well at Bank of America. So I made markets in just about, ETFs touch every nook and cranny of the market. Fits very well with my style of trading. You could trade anything and everything with ETFs. That's why I love them so much. So I made markets in all of these types of instruments. My Twitter handle at @CFromhertz. I'm much more active than I used to be on Twitter. I don't put out every trade. I try to put substantial things out, things that have meaning. Some guys I see tweet every trade that goes up. I don't do that. I trade, I'll put on things on Twitter that I think are really important. So that is me. That's my view. That's what I'm looking at right now. I've lived in Battery Park. Somebody was just asking me that this weekend. And about 2007. So I've been in Battery Park for a long time, right next to Tribeca, hence Tribeca Trade Group. So weekly review. Before I get into the subject matter, I always like to go through a quick 5 or 10 minutes. It actually ties very well into talking about bullish and bearish sectors. What's up, Chet? How you doing? So I always like to go through about 10 minutes or so of what's been going on in the marketplace. Just gives a good glimpse of what's been going on. If you're an SPX trader, you might as well be on vacation. 11 days in a row where we've crossed 2165. We've been up or down, 10, 15, 20 basis points. So is this consolidation or are we rolling over? A couple things. I'm not completely decided on that right now. I think that we got almost to overbought levels. Right, so what I like to do in these webinars is bring a lot of charts in. I was looking at obviously Amazon earlier. So we'll bring up S&P futures. Let me just turn off a couple of things because my charts are so busy. And it becomes a little bit cleaner when you take a couple things off here. Oh, targets are off. I think that's how I want it to be. So let me look at just the daily chart of the S&P. If Thinkorswim will cooperate. So here's the 11 days. You can kind of go through. I did count these. How many days that we've crossed. I actually looked at the SPX, so SPY might be a little bit different. But we've had a really nice run, right? I can never zoom out appropriately, but we've had a really nice run from the Brexit. I view this as kind of positive. We didn't exactly get overbought, but we've been kind of just running along this line. unless something really negative happens, I think we're kind of gearing up for another like higher. If we, maybe we roll over down to the blue line, which I'm surprised we haven't at this point. I'm surprised we just haven't come in a couple days and touched the blue line. I used the 20-period exponential moving average just to kind of tell me what kind of trend we're in. So we really haven't consolidated too much. We've kind of just been trying to figure out what way we're doing. That's fine. You don't necessarily need to know whether the market is going up or down. Why is that? Because implied correlations are at a 1-year low. You could pull this up, I think, in stock charts. So why is this important to know? This is a chart of implied correlations. What does that mean? It means whether or not the components of the S&P index, the 500 names, whether they're moving together or whether they're moving apart. If they're moving together, usually it's a higher volatility type atmosphere. This is probably where Brexit was. Everything moves together when there's a high correlation, and it doesn't really matter what you own. When there's a big up day, you could pick any stock and it's most likely going to be up, or higher probability. When there's higher volatility as well, it's better to trade futures. It's better to be an index trader, right? Big moves, you could be long, you could be short, you could take advantage of big swings. That is not the kind of market that we're in right now. We're in, just as I went over, 11 days of crossing over the same level. It is not a market right now to be an index trader. It's not, you always have to adapt to the market in place. No reason to be trading S&P futures right now. None, absolutely none. Until this changes, until the game changes. So what kind of market are we in? And anybody, before I reveal the slide, what kind of market are we in? I've been saying this in the room, but if you don't respond, I see typing, good, typing. Stock pickers market, exactly. There's not a better time right now to be trading, to be trading stocks through options or through cash. They are moving. You can run a long short portfolio and you can make money on both sides right now. That's the type of market it's in. So you always want to know, going back to how I trade on macro, you want to know what market you're in. You don't want to be sitting twiddling your thumbs trading, the wrong things. So if this market goes up, if the implied correlations start to go really high and the volatility goes up, then you want to trade, S&P futures, NASDAQ, small cap futures, those types of things, or IWM, SPY, Qs, doesn't matter, whatever. The liquidity is great for both of those. So implied correlations at a 1-year low. What kind of market we're in? We're in a stock pickers market. So this is a perfect example. Metals and mining this week. This is all of this week's data. Metals and mining up 7.3%. Semis up 3.5%. Biotech up 2.7%. And then you have oil services, and you have a couple other areas. Oil services down 3.4%. Same thing with XOP. That's OIH, XOP, XLE, also down a clip. All right, you could be short oil names and you could be long semis and be making money on both sides of the spectrum. What else? Defensives. Defensives have been taking a breather. These are some. I'm going to get into some of the fund flows and how much money has been going into these groups. Very much a yield-oriented place. It kind of makes sense. Why the consumer staples, why utilities, why REITs have been being bought in chunks, because you're getting better yield in those places and people have been running for yield. However, they're starting to take a breather. Is it just a little bit of a pullback? Or is it a trend change? We'll see. One of the things to brings us to the next bullet. One of the things to watch is the 10-year yields. 10-year yields got all the way down to about 1.35%. Right around Brexit, it's moved up a bit to 1.5. I'm not so sure that yields are completely breaking down. If you look at the long bond, which is the 30-year bond, you could see that we kind of paused a bit. It's going to be interesting what the next move is here, but we held the top of value pretty well. You see a couple hammers, a couple really long wicks here, meaning we maintain this level. So I'm not sure that we're going to break out to new highs in the bonds, But for now, we're above these 2 short-term moving averages. We're almost firing off a buy signal on the Raptor indicator. So, technically speaking, it looks pretty, a pretty nice pause in the uptrend for now for bonds. So that's going to be one of the key factors if money rotates out of defensives and into other places, which I'm going to get to in a minute. So implications of the yield at 1.5%, other than the yield, the trade for yield. A lot of talk about Tina. Whoops. A lot of talk about Tina. There is no other alternative. There's a case for that, I think. There's not a lot of places to put your money. You're not earning money by putting in cash. So not a lot of motivation to put your money, on the sidelines other than to be away from market volatility. The other big benefit of, people always look at the negatives, like, oh my God, yields are going lower. This is not a good sign for the economy, not a good signal. What is it good? I always try to focus on the positives. What is it good for? Cheap financing for M&A. How many names have we seen chatter about? How many names there's another name bought out today, NetSuite. As long as I think yields are under the 10 years under 2%, I think it's a good environment for M&A right now. And I think we're going to continue to hear chatter about takeouts. So that's a good thing. We're seeing a lot of option activity in buyout names. We see a lot of chatter. We've been picking up a lot of those, a lot of that chatter in the trading room. Pat, MQ, these guys have been doing an awesome job at picking this stuff up and making profits on a lot of M&A names. Really, really good trades in the room in the last couple of months. So I think that environment is going to continue. So if the yields remain low, still good for consumer staples, REITs, utilities. They may continue to be hot. Also look for M&A plays, small cap names. Right now we're seeing that in technology, but that could be more, another source of targets to get taken out. Things to watch. This really hasn't changed too much, I think, from my last webinar. U.S. dollar started to get strong. That could be a little bit of a hindrance, especially to multinational corporations. I was actually pleasantly surprised to see the dollar go down a bit today. We've been kind of moving in this uptrend. Certainly don't want to see us get back to December highs. So that, especially for names like multinational groups like industrials, consumer staples, and so forth, that could be a pretty big negative. So I actually like to see that the dollar went down. It's not really breaking trend, still in the uptrend, but maybe a little bit of a breather. Also, gradual increases are much better than big increases with the dollar. Other things to watch. I like to look at the Baltic Dry Index. Why do I do that? I don't look at it every single day, but I do like to look at the trend. Why do I like to look at that? The solid white line on the bottom is the Baltic Dry Index. There's a decent correlation between the Baltic Dry Index and equities. So notice that this move up in the Baltic Dry kind of coincides with that move up in, regardless of the Brexit dip. But the Baltic Dry, was moving previously up. It's actually coming off a little bit, which worries me a little bit. Let's see if, don't want to see it come down here. Just a good indicator of global economic activity. So this is something that I'll look at every couple of days. It's okay right now, but I don't like the fact that it's starting to taper off a little bit. What else? Crude is starting to pick up volatility to the downside. I think we've seen about 6 days of declines in crude. However, some good news from a technical standpoint. I think anyway. We'll see. We'll see if it holds. So on the new TTG market webs, the VPOCs are automatically drawn for you. The purple lines are the VPOCs, which are version pointed controls. They often act as magnets. That's a whole nother webinar to talk about those. But basically, we've There was one back here from the week or the month of May. So we've actually come back and taken out that level. Sometimes we revert. So we were looking at that in a couple names today. Where are we now? What's the next level of support? Here's the good news. Let's see if we hold. If you look at the weekly chart, this is the yearly value area. And crude is almost touching the bottom of value. It's a pretty big support area. That is, so you could write that one down if you like, 40.72. If we break that, we're going to have more, we may have more downside ahead. But if we hold, sometimes these value areas, you do dip below it and then just punch right back. So even if we break it, I would be looking for a retrace. So I think that's a good sign. It may set up, we'll see how this plays out. If it holds, maybe sets up as a long, but we don't know that yet. Too early to speculate. Okay, so that is how much time did I take up? Probably a little bit more than 10 or 15 minutes. Any questions so far on state of the economy or the quick economic overview? What I like to watch? Yes, no, yes, no. All right, moving right along. Okay, so let's talk about earnings trades. We're in the thick of earnings trades. We just had a couple of the big hitters report, Google, Amazon today, a bunch of other names. A little bit, every earnings cycle is a little bit different. I think this time what we're seeing, before I get into the earnings game plan, what are we seeing so far? A lot of initial reactions, go one way and then, move back. We've seen a lot of names that have run into earnings. Some names have continued to power through. Some names have come back, like Facebook was a good example of that, a name that ran all the way into earnings. Stellar earnings report, but it was a little bit overbought by the time it reported earnings. So these are things that I'm going to go over. These are all things that you want to think about when taking earnings trades. So first off, as you're taking earnings trades, document your trades. Know what your return on investment is. The only way to really do this is in a spreadsheet. There's no way, at least that I know about, there's no trading platform that's just going to say sort for you what your earnings trades were. There's no way to filter that, unless you have something that you can label each trade. If not, keep track of it in a spreadsheet. That's what I do. And I want to make sure the reason why I do that is just as a trader, you always want to review, just like we were talking about today. I took one bad trade today, figured out, okay, what did I do wrong in that situation? This way I don't repeat it. So same thing, I want to find out what works and what doesn't. And I don't want to do the trades. I don't want to do the things that I was doing bad before. So like any trade, it's for earnings trades or like other trades in the sense that you want a batting average, you want a high batting average. If you don't have a high batting average, it's very difficult to take profits. So try to aim for greater than 50% winners in earnings trades. That will give you a positive return on investment, because a lot of trades, which I'm going to go into that, you're going to try not to risk a lot of money, and you're going to try to hit your occasional double or triple. Big thing in here, which it blows my mind all the time with traders. Pat made a comment about this a couple days ago, I think. He said, I've seen a lot of traders blow up on earnings. And I said, really? I don't, Pat, you're welcome to come on, talk about this, but I don't understand, to me, I can't fathom how that happens. You shouldn't, earnings are a very difficult thing to predict. And I'm going to go through some of the points that we're going to go through in my earnings selection. But even still, it is a very unpredictable event. So what I do is I don't risk. My average earnings trade is probably about $200 or $250. You can't blow yourself up or have a really bad time trading that type of risk. And that's my type of trade. You could do this with $100. You could do it with $150. Maybe you could do it a little bit more than $300. But I would say don't go over 500. Not going over a certain threshold kind of keeps you in check. just as you do with normal swing trades or day trades. What is your threshold? Is it, $5,000 a trade? Is it $10,000 a trade, a swing trade? Earnings trades are much different. Don't risk a lot of money doing these. Again, I can't give recommendations or advice, but that is personally something that. Go ahead, Pat. Thanks, Pat. So that's, Pat says, well, it's kind of a bet. So what I'm trying to do is kind of get away from the casino bet and try to stack the odds in your favor a little bit. And try to get for those over 50% winners. That's how I've achieved, for the first 2 weeks. And I think for the first 3 weeks, it's probably going to be a return on investment. It's going to be about 56, probably about 60%. So that's the first thing. I always like to go over that first because that is the crucial thing. Don't go crazy with earnings trades. Don't risk thousands of dollars on earnings trades. Crazy to do that, no matter how much you like a stock. So proper risk to reward, the implied, why it's more difficult than the average trade is the implied volatility is much higher. I think we all realize that. We were, contemplating a couple trades earlier in the week, day trades, like normally people do in Amazon and Google. And the price of the option, the premium of the price of the options is just through the roof, right? Amazon was a great example. It's like, how the hell are you going to trade this stuff when it's, $2,500 a contract? So that's the risk that you're dealing with, is that the implied volatility is so much higher than normal going into earnings. The cost is so much higher. So how do you minimize that? Spreads. The majority of trades that I do in earnings are spread trades. So you're buying one contract at one strike and you're selling another one. You can also sell premium. You can also sell the nearer dated strike and you can buy the further one out. You're essentially selling premium. Probably the odds of, the take of what I do is probably 70%, where, I'm going long, or not going long, but I have a directional trade on, and 30% I'm selling premium. And that changes depending on the move. But I made money in a couple different Chipotle was a great name where I sold an iron condor. Netflix was another one where I sold call spreads. I don't know, maybe it's a little more like 60-40. Okay, so let's go over some of the basics. So that's kind of the gist of options trading. Number one, don't risk a lot of money. Number two, be cognizant of the implied volatility spike and how to position your trade. Going outright calls and puts, probably not the best thing. It depends on the name. Every once in a while, you come across a name where the implied volatility is really low, and you can get into a position going straight calls, but it's rare. I think one trade I did this week was KKR, very, a name similar to Blackstone. I think I was able to get into some August calls for like 34 cents. And for whatever reason, I wasn't going to question it, but the implied volatility was very low in that name and was able to take, profits up at 80 cents. So once in a while, you can find it. It's kind of the diamond in the rough. So first thing you want to do, calculate the implied move. So we're going to refer to that as IM. Anybody not know what the implied move is or how to calculate it? So I don't want to spend 15 minutes on calculating these things. We do this every day in the trading room, and happy to go over this in detail in the trading room, but through a webinar it just takes a long time. So I'll give a quick example, but don't be shy if you don't know what the implied move is, or if you don't know how to calculate it. I will say what it is, but just want to get the kind of the scope of the group. like I said, most people in here are members of Tribeca Trade Group, so I would imagine most of you know how to do this already. But anyway, I don't see anybody saying that they don't know how to do it. But what it is you're basically taking the at-the-money calls and the puts of the most near-dated maturity of the option. So this week it's the 729s. You're adding those two at the money, adding the price of the calls, adding the price of the puts together, and then dividing by the stock price. So that'll get you a percentage of the move. Next thing you want to do is take that implied move and apply it to the price of the stock. So we're going to walk through one example. Like I said, I don't want to spend too much time, but I do want to go over an example just so everybody gets the idea. So one of the things that I look at is the history, right? So we want to find out, I'm going to use the example of Google today because it's fresh. So, what did it do? Last quarter, 5.4 was down. Previous quarters, a lot of green. 5 quarters green. A miss, but, if you take the average of these, it looks pretty good. What I also want to do is, I think people make the mistake sometimes of just looking at the history and they don't foot this to where the stock was. That's where I kind of add a wrinkle into this. You don't just want to look to see, okay, well, great. The stock went down 5.4% last earnings quarter. Well, where was the stock? Was the stock overbought at that time frame? Had it, did it top out? What was the sentiment at that time? So just looking at the raw numbers tells me jack squat. It tells me, okay, maybe not jack squat. It tells me it's had a history of beating earnings, but it still doesn't really tell me, it doesn't give me a good gauge of what it's going to do today. You need to go through another layer of analysis. So we'll bring up Google, just go through this quickly. Where are we now? 800. Wow, right at the implied move, which we're going to go over in a minute. Oh, yeah, so Google was one of those names where we talked about the VPOCs. Take a look at the VPOC here. Yeah, I mean, you can't make this up any better. This is where we turned around. We took out this level and then reversed. So you can use these to trade pretty damn well. But here we go. Here's where we missed earnings last time. Look at the stock. It's overbought going into earnings. The RSI was around a 70. Also pretty close to an all-time high. So this helps me, going into, my return on investment last couple of weeks. I use a bit of a formula. I don't like to buy, I kind of use a process of elimination. Is the stock overbought going into earnings? Yes. What happened? It declined 5.4%. So while I liked Google last earnings report, and I don't remember if I played Google to the long side. Maybe I did, but it was probably on the very small side because I saw that it was overbought. I don't want to take an earnings trade when a stock is overbought, regardless of if it has a history of positive beats. Or if I do, I want to scale. I want to make it of a small size. If I normally risk $300 on a trade, maybe I'll just do $100. So let me just continue with the analysis. So where was the stock trading the last couple of earnings reports? Was it overbought? Was it oversold? You could use the RSI to help you with this, the relative strength index. You could also look at Bollinger Bands too. So was it overbought, oversold? I think we covered that. This has been a theme, I think, of this quarter. Not sure if he's in here, but Spinner has been talking about this. What's the short interest on the stock? We've seen this in a lot of names. A lot of names that have a huge short interest and they've actually gapped up. So something to keep in mind is check the short interest on a stock. Is it way over, is this, because what'll happen is if there's a big short interest and the stock actually does have good earnings, a lot of the shorts are going to have to cover. That's going to bring the stock. That's going to give the stock legs. It's going to extend it. Facebook. I don't think a name with a big short interest. I think the longs. Bring up Facebook. I think the longs took profits today. Not a name with a big short interest. So shorts don't have to really cover. It's a name that is owned by a lot of longs. So also another reason that it's very difficult for a name to kind of keep going. So all things to consider. I think names that have short interest, they've been popping. I'm sorry I don't have a list of names that have a high short interest, but if any one of the other moderators wants to come on. But we've seen this probably about 5 or 6 different times. A couple names with really high short interest have popped really well. Those are the things that we're looking for. What is the sentiment? Is everyone leaning to one side? We've seen this kind of with I think with Netflix, seen it with Facebook. So that initial pop being faded. Again, I don't want, if everybody says, yeah, I like this name for earnings. I think we saw that with, I think Apple was a good example of that. The sentiment was so bad in Apple that the name, Apple did have beat their numbers, but where was the sentiment going into Apple? Everybody's saying, oh, I don't think how Apple can do anything on earnings, right? Is everybody leaning to one side of the fence? Those also set up for good contrarian plays and for earnings names. So you want to go through a checklist. You could write this down on a piece of paper. You could print this, kind of go through your checklist. If it doesn't meet one of these, or if it meets one of these criteria, like it's overbought and you're looking for a long play, scrap it. Or reduce the size. Go from the $300 play to a $100 play. That helped me, and I'm going to go through the names where I've made money and the names I've lost money in. But that's helped me, okay, you lost $100 on a trade. Meanwhile, another trade that I've, ramped up in because it met all the criteria, did much better. One bullet that I don't have on here is be patient. There's so many names that are there have been so many names. I think those of you who are members of the room, how many names have I looked at and I said, nope, don't like it. Nope, don't like it. Went through, looked at the implied move, looked at the history, didn't meet all the criteria. Nope, didn't take it. Now, not to say that just because I don't take it, it's not going to work, but it's just not going to work for me. There's plenty of other names that are going to work. So being highly selective and being patient, don't get anxious. Just like when we're trading any other trades, sit back, wait for your pitch, wait for the right trade, wait for the right setup. That helps in any type of trading. There he is. Go ahead, Pat. Great points as usual. Awesome, and Pat does this every Monday. He's so patient. He'll look for the right trend on Monday, and I'll say, Pat, what are you thinking today? I'm just watching, and it doesn't mean he never trades on Monday, but he's got the good philosophy and he follows it. And we've all been doing this for a long time. I've been trading since. Sorry to show my age. but I've been trading since 1999, and it doesn't ever get easy to sit on your hands and wait for the right trade and to be patient and disciplined. Extremely hard to do, especially when everything's going the right way. I mean, you get overconfident, and it's a constant struggle, and that's why trading is so hard. Otherwise, everybody would be making money doing it. Okay, so last bullet point, because I want to keep going here. We're about 45 minutes in. So the final thing is look at valuation. Good example of this is consumer staples. One of these groups that has been extremely on fire because of the yield trade. What's been happening to the consumer staples space? Not every name, but Coca-Cola, boom, to the downside. McDonald's, big run into earnings, to the downside. So there's about 5 or 6 other consumer staples names that have done this. I just can't think of them on the spot right this second. But why is that? The valuation is much higher than historic levels. So they have to have perfect numbers. Previously, when their valuations were something like the PE ratio was like a 12, it was like, okay, if they beat a little bit, they're going to move up. Now with the valuations in a lot of these consumer staples over a 20, they have to have, they have to knock the cover off the ball. And if they don't, they're going to get punished. So you have to look at a little bit of valuation as well. So that's the checklist that you want to go through. Doesn't meet the checklist, don't take the trade. Okay, so now we're going to get into the nitty gritty a little bit. So that takes care of these bullets. So what is the cost of the spread using the implied move versus going inside of it? So I'm going to go through an example to show you what I mean. Google, today's implied move. So using that calculation, looking at the near, front week, which is 729, this week's, or the weeklies, right? 729 options that expire, looking at the money calls and puts, adding the premium together, dividing by the stock price. Implied move was 5.1% for Google. Now, if you wanted to play, I didn't even put the downside, but just to make it simple, what was the range? Where did that go up to? 801. So what was it? 765 early, at the close. So the implied move 5.1% gets you to 801. Funny, where are we trading now? Pretty damn close to that implied move. Almost kind of, I have a deja vu of watching this versus what we saw last night in Facebook. Right? Looks pretty similar. So who knows what's going to happen? We'll see what happens in the overnight session and into tomorrow. But that looks very reminiscent of what Facebook looked like last night. But anyway, implied move 801. Now, do you have to trade all the way up to the implied move? That's going to be the cheapest trade to put on. Using and the most optimal if you're going to do that. If you're going to try to say that the stock's only going to go to the, that the market maker has it right, you're gonna want to trade the 795 800 call spread or something to that effect. Maybe a not as wide strike, not as wide spread. Excuse me. Sorry, it's been a long day. So that's a $5 wide spread. Maybe you can shorten that up if you don't want to risk that much. How much does that cost? When you purchase the 795 calls and you sell the 800s, gets it to a price of $1.90. Well, how much money is it to go inside of that? What if the market maker isn't right? They're always wrong. But every once in a while, it pins around the implied move. Sometimes they're right. Sorry, I shouldn't say they're always wrong. They're not always right. How about that? So even if it beats, a lot of the times what frustrates me is when you pick the direction right, but you don't have enough juice. You didn't, the stock, maybe it hit the implied move, but then it sold off from there, similar to what Facebook did, right? Facebook, I think, went over the implied move, but it wasn't there for long. And it's very difficult to hedge. To hedge pre-market, which you can do, you could delta hedge, when you have calls outright. Very difficult to do when you have a call spread, because if the stock keeps going, you're capped to your upside. So not easy to delta hedge. So you can't really do much. You can't protect yourself too much pre-market or after hours. So that's one of the most frustrating things to me with earnings trades is it goes the right way, but it doesn't go far enough. So what's the difference between going to the mark to the implied move versus going inside of it? This is reverse. I'm sorry about that. This should be $1.90 and this was $1.65. So sorry about that typo there. There's always typos in here. So the cost of the 795-800 call spread was $1.65. If you go inside of that, the cost was a little bit more, like $1.90. Does that make sense to you? Are you willing to go? Does the extra cost of using a closer spread, closer to in the money, and paying an extra 25 cents, is it worth it in your opinion? That's a personal choice. In my opinion, in my experience, I have a better return by spending the extra 25 cents and going down $5 or $8, whatever. And I have to double check the prices because I like I said, I put this together really quickly. But it doesn't have to be. This doesn't have to be exactly okay. It's 25 cents cheaper. You want to be able to make a judgment. Is it worth paying a little bit more, 25 cents more, to get a higher probability of winning on that trade? That's what I'm trying to focus on here. And I do that a lot of times. If it makes sense. If it doesn't make sense, maybe I don't do the trade. But a lot of the times I don't need to go to the implied move because to me, it's great when it happens and you spend less money. You're going to get a little bit more bang for your buck, but I don't mind spending maybe 10 or 15. Sometimes it's 10 or 15 cents. Sometimes you get lucky where the market maker doesn't have a big curve for the cost of the options. So you always want to check out a couple different strikes and find out, okay, well, I don't mind spending about 10 or 15 cents for a cheaper, for a more expensive but closer to the money call spread. So that's another strategy that I like to do. And that increases my win percentage, because I've had a lot of times where I play all the way to the implied move, and either it's there pre-market, and by the time the market opens, it's gone. The profit taking starts coming in, and the stock reverts. So you can assure yourself a better, higher probability of taking money, taking profits. Okay, so we talked about any questions so far on these concepts? Please ask away questions, because this is for you to try to decide if this is the right trade for you, how to play these earnings trades, or maybe earnings trades are not for you. You avoid them. There's other strategies to do than the straight up earnings trades. You can look at names. I'm going to talk about one, how I turned a loser into a winner. No questions? All right, moving on. So we talked about the next bullet's, like any trade, get your batting average. Very important. I never like to take trades where, I'm winning 30% of the time. Don't care for them. And if it turns out that that's what you come up with, not the best, not an optimal strategy. Another best practice that I like to do is rank, as we're going through each name, what I've gotten the habit of doing is, what's my strength? How much do I like this setup? How much did it meet the previous bullets, the checklist? I think I did take a Facebook long, and I said, I like this. I think a 6 out of 10. Didn't meet all my criteria, and it wasn't a big trade for me. Hence, won't be a big loser. So what if, always like to kind of give you concrete numbers, show you exactly what we've done. Obviously, everybody in the room sees these. Winners from the last 2 weeks: Alcoa, Fast, Netflix, UNH, Microsoft, AXP, Biogen, CMG. Losers, I've actually had a decent amount of them. We've had 1, 2, 3, 4, 5, 6, 7, 8 winners. 3, 6, 7, so slightly above 50%. Where I want to be, I'd rather be at 65, 70%, but still, I'm above 50%. So what does that equate to? It equates to a return on investment of 50%. So I keep track of every price I take, what the strike is, how much I spent every target. I know this is laborsome. Only way I could figure out if I'm winning or losing doing this trade. Otherwise, you're just, you're coming in every day, you're putting on trades, you don't know if you're winning or losing. I don't know. How'd you do in earnings this quarter? I think I did okay. Horrible response, right? How'd you do in earnings this quarter? I'm up 50. My return on investment is 50%. Am I going to do earnings trades next quarter? Absolutely. So this week, how have I been doing this week? So what have we got so far? If you go to that pink section in the notes tab, FCX winner, DuPont winner, KKR winner, Caterpillar loser. Nice turnaround in GLW today. Ended up being a winner. Apple, Iron Condor lost. I thought we would trade in a range. We talked about sentiment in Apple. I still have tomorrow, but I don't think that's going to work on the call side. Put side, great. GX Strangle. So we also do in the room event trades. I did this for FOMC trade. It's not going to go into the earnings trade because it's not an earnings trade, into the earnings spreadsheet, but huge winner on the GDX Strangle. And Strangles, they work when the implied volatility is low. GDX didn't have a high implied volatility for FOMC. That's why I chose that trade. Facebook, uncertain. Don't know, but could be a loser. Amazon looks great right now for the Iron Condor that I sold. Bank of Japan, which is an event trade. That's DXJ, not DXH. We'll see how that goes. Google didn't meet all my criteria. One contract today, so be it. All right, any questions? We've actually gone an hour, so I have this for an hour and a half. So the rest of the presentations, sometimes you don't know. I try to cover 2 subjects in the webinar tonight. Any questions so far? Anything about the methodology? Anything that you guys want to talk about earnings? Because we're going to leave this subject and go on to something else. Very quiet group tonight. Not a lot of questions. So I hope this helps. Is this a helpful game plan? Is this something that you guys were doing? Is there a benefit? Do you find? I find good, very helpful. Kathy says, I find that, it's important. The bottom line is, you got to go over the basics first. This risking, as Pat said, people blown up on earnings trades, which blows my mind that people have done that. But so you got to go over the basics, and what the structure of the trade, how much you're risking, and so on and so forth. Okay, so I don't see anything else. So let's go over a little bit of trends. We'll go over this for about 10 minutes because my voice will probably cut out soon. But so every day I look at ETF fund flows. Why am I doing this? Somebody asks me this every once in a while on Twitter. Why are you looking at these numbers? What does it tell you? What's the objective of doing this? Trying to spot trends. Just like we look at flows, we look at option prints all day long. What are we looking for? We're looking for trends. We're looking for names that goes up, names that go down. You know, a good example of this is, you know, when you take its purest form, something that I've been talking about all year long, especially the beginning of the year, gold inflows. You know, GLD, you could see, so what are these two lines? The white line is the investment into gold this year, the outstanding shares, how much money has been accumulating. So these things you can follow in ETFs through what's called the creation and redemption market. Outstanding shares get reported on a daily basis in Bloomberg. So very easy to follow along. For me, I know how to do it. I was an ETF trader. So I look at this every day. I want to see who's buying what and who's selling what, right? And these are facts, right? I know for sure, you know, we can speculate on option activity. Oh, maybe they're buying, maybe they're selling. We don't know. We never know where their position is. I know, you know, by watching inflows and outflows, if people are buying or selling. It's proof. Look at the price of GLD go up with the investment. It's 1-for-1. GLD as people, January, February, huge inflows. What did the price of gold do? It moved up as people were buying. People were buying. Price goes up. You know, so right around Brexit, you know, what has the recent trend been? You know, there's been a little money coming out of gold. You could see the price of gold come down a little bit. So the outflows have steadied. And we'll see what happens now. So this has been 6 strong months of inflows. You know, we'll see what happens. You know, other things that I've been watching, emerging markets, a lot of inflows. Then you start looking at the charts. Well, somebody's buying emerging markets. What do the charts tell you? So EM right now is my biggest trade. Why is it my biggest trade? Every day I've been seeing inflows. Oh, not every day, almost every day, large inflows. Also, took a long time, but it's in the value area. Anybody know what the value area rule is? That, you know, not set in stone, but some people kind of live and die by this. Once you get into once you're firmly in the value area, what's the percentage chance that you go from the bottom to the top? There you go. Nice. Hey, you guys know your value area studies. 80%. Yeah. I was just talking to Webb about this, the creator of this particular study. And, you know, he says, make sure it's firmly in value. So it's happened a couple times, kind of ducked in a couple times and ducked right out. I think it's firmly in value. So based on the academics of the value area study, they say it's an 80% chance, some place where I want to put my money. Also, take a look at this big green arrow on the Raptor indicator. Beautiful. I love it when you get the buy signal on the Raptor right when you're going into the weekly value area. So, you know, this is a you know, this is the weekly chart. It's the yearly value area. This is going to take some time. So what did I do? I have the January calls on in EM. You know, got to match up the chart. So anyway, kind of getting off base a bit, but that's why I watch fund flows. Gives me a heads up to what's going on. So what's been happening in the US sector fund flows? Look at the amount of money that's been going into REITs, utilities, actually energy, you know, probably buying on the dip. Materials, which a lot of that is your GDX, GDXJ, XME, consumer staples. What's been lagging? What hasn't gotten any? Where's the money come from? Probably to go into these sectors. Look at how much money has been taken out of, you know, this is not a big shock. I think financials, the biggest outflow, probably doesn't surprise anybody. Financials having a tough time making money right now. Low interest rates, a lot of high regulations, low volume, so not making a ton of money trading. IPO market just started to pick up over this last month, but for the beginning of the year, you know, no underwriting. You know, maybe they're making some money now with the M&A heating up, but some of those traditional avenues that banks make money in, you know, not too bright of a picture, right? So that makes sense to me. Some of the other groups, big unwind of technology. Most of this has come in the beginning of the year. Sorry, healthcare. But look at consumer discretionary, look at technology. So if money starts to be reallocated back into these groups, you got to watch the 10-year. If yields start to spike, money starts to come out of these groups, may come into here. Also, I think people are adding, we saw, which I was kind of banging the desk on the table every day, because we saw just a huge amount of the biggest inflows, equity inflows that we saw all year long was the 2 weeks after the Brexit. So I was on Twitter every day saying record inflows, record inflows. So money was really coming out. The fund that, I actually had an article about this. And I was kind of talking about this as the most important chart. Let me just fix this. Okay, so this is BSV. This is cash, essentially cash. Good way, and a lot of people don't track this because they don't know, frankly, how to do it. But a lot of people put money into these types of very short duration bond funds as a way just to put money in cash, take money off the sidelines. It's not really going to move. It's essentially a cash equivalent. Look at this date. When did money? So look at all, for the last, all of January, cash balances have been going up. Money has been going into cash equivalents. This is the chart of outstanding shares. First of all, what is BSV? Sorry. And how big is the fund? Just so you see, short-term bond fund, 1 to 5 year government bonds, no risk, right? How big is this fund? Huge, $18 billion, $18 billion fund. It's got some weight behind it. Somebody starts taking money out of this thing and redeploying it, most likely equities are going to go up. It's going to be buying. So when did this happen? What was, anybody know the date of the Brexit off the top of their head? Date of the Brexit. It's a good question, right? Feels like it just happened, but right, June 23rd. When did the money start coming out of cash and back into the stock market? 22nd was the day before. 24th. All through the end of June into July, money came, big block of money came out of cash and went into the stock market. Right. So these are the things that I track on a day-to-day basis. I want to see if people, and I have a way of doing it, a lot of people don't, to track whether cash is coming off the sideline, off the sidelines. All right, so that could also, so we don't necessarily, the point of this, why I'm showing that is because with cash balances very high, even if the interest rates stay low and we don't get a sector rotation, you could still see some money being put into technology and into healthcare and into consumer discretionary. So that's where I'm kind of focused on, those three groups that are underperforming. Technology has been on fire the last couple of weeks. So, why do I do this? Again, I'm a macro trader. I will look at from top down, and, kind of middle in the road of that top down is sectors. So I see a ton of money that's come out of these groups. At some point, I think the money goes back in. So I'm looking in the technology sector. I'm looking in consumer discretionary. I'm looking for names that have been where the money has taken out. I think eventually it'll come back in. Nice answer, by the way, Stephen. Oh, before I show that slide, anybody, so the next slide, I'm going to show what funds have attracted the most money year to date. Anybody have any guesses? What do you think that the ETFs that have tracked the most assets this year? Any guesses? I bet you there will be, yeah, GLD is number one. Correct, John. Excellent. GLD has, out of all the ETFs out there, there's, almost 2,000 of them. GLD has seen the most inflows. Partially. So this is just one particular fund I'm going to show you. Energy. So you got to pick the ETF. Sorry, I was a little vague on that. But good guess. Same thing with short-term bonds. There is definitely a bond ETF that's seen the most inflows. Any guesses on the ETF with the biggest outflows? Ooh, good guess. VPU. I like strong guess. Any guesses on what funds have seen the biggest outflow, or what ETF has seen the biggest outflow year to date? Oh, good get. MQ says VGK for outflow. I think you're pretty damn near close. Okay, so let's go through this because I know we're pushing past an hour now. So, okay, so this is tabulated from the beginning of the year. What funds have seen the most market value, the most assets? Pretty startling, right? GLD, $13 billion of inflows this year. One that nobody's going to probably know, which I've been talking about on Twitter. Well, the second one is aggregate bonds. So basically, corporate bonds, high yield bonds. Aggregate bonds is mostly corporate bonds. So pretty big inflow there. Same thing with LQD. Pretty big investment into investment grade bonds. So one name that people are not that familiar with is USMV. $7 billion this fund has attracted. Huge. That's a 90% change in fund size this year. Anybody have any idea what sectors are in USMV? I know I talk about this in the room. Let's see if you guys pay attention. Yep, Utes. What do you think about it? What's minimum volatility? What names? They should have just called the fund defensive equities. That will probably clue you in. Yep. So Utes, utilities, consumer staples, REITs. So I didn't even have, this. So this $7 billion, when you couple that with these, keep in mind, USMB is not included in here because the way I tabulate this from Bloomberg is whether the fund is called a utility fund or whether it's called a REIT fund, like the VPU or VNQ. USMV is multi-sectors, so it's not even covering that. So these numbers are even more ginormous than that. So what else? International developed has actually attracted 5.5 million. Up there, I think someone said VGK, very similar. HEDJ, also EZU. A lot of money has come out of Europe, and that's been steady all year long. A lot of money has come out of Japan as well. EWJ is up there. Japan is up there twice. Japan and Europe in the top six twice. This is Europe without the FX, but mainly the same stocks as EZU. Just one is currency hedged, one's not. Same thing with EWJ and DXJ. And then you got XLF up there as well as some of the biggest outflows. But pretty crazy, right? A lot of money coming out of here. So I guess a real contrarian trade would be to go into Europe right now. I'm not sure if I'm ready to do that. But I would wait. I'll wait until I see money start to go back in, which I have not seen. So it's a good way for me. Like, I'm not going to play Europe or Japan really for a long swing trade unless I start to see money started being added, hand over fist back in there. So you guys had a couple names that you mentioned. I just want to kind of show you. Somebody said VPU. That has seen about $400 million. Somebody said VGK. Oops. $2.6 billion. So that's on the list. That didn't make the top six, but pretty damn near close. MQ. So look at that, 3 European funds. You add these together. So this is the kind of stuff I track. $14 billion of outflows. Woo-wee! $14 billion of outflows. And then you look at on the plus side, what's the REIT one? Drawing a blank. VNQ. Just off the top of the list, this was top 6. Number 7 is VNQ. So that is your big REIT ETF. $4.4 billion this year. All right, so that's the end of the presentation. Anybody have any questions? That's it. That's all I wanted to cover. You know, I've mentioned earlier in the trading room, if anybody has any other questions, you know, there's a lot of good topics that people want to go over. You know, we've gone over you know, by the way, if you're not a member, you know, we go over the earnings trades in detail. You know, you could try it for free, no obligation. That is on our website. You know, you get a ton of stuff included in our room. I'm not going to go crazy selling you guys, because I know most of you guys are members in the room. But you know, obviously, I think we've got the best trading room in the world. We provide more services, I think, than you know, concrete services than most trading rooms. Our weekend newsletter, I don't know anybody who writes a better newsletter, sorry, than I do. Our moderators are extremely experienced, and Pat's trading plan is awesome that he sends out every day. And then you get all the bells and whistles like text trade alerts and all that fun stuff. So TribecaTradeGroup.com, you know, you get a week free to try it out, no obligation. You can cancel anytime you want. Don't even have to tell me about it. So, but I want people to check it out. I don't think people are going to be disappointed. So any other questions before we wrap it up for the evening? Anything that we went over, anything on earnings, trends, anything in option trading off the subject? I'm going to stop the recording now, so this will be put up for review. Not yet. Not yet. Close, couple times, but no.